Chairman sir, should we start?
Yes, very good.
Good evening all. I welcome you all for this webinar on investors awareness, Forex risk management. I invite CA Deepak Ladda, Chairman of the branch, CA Rajambal, Management Committee member, and all the speakers and the members to this webinar. Now I request CA Deepak Ladda to give his welcome address and overview of the program.
Thank you, Secretary Ravi Shankar Reddy. Respected speaker of the day, Sri Abhishek Gaur from NSC and Siddesh Khare sir, who are experts in Forex risk management. At the outside, I thank you, sir, for accepting our invitation and addressing to Hyderabad branch members on such an important topic. I also recognize the presence of my colleague in the managing committee, Sri Rajambal ma'am, and all the members who have joined by this time. A warm good evening to all of you on a Saturday evening. And friends, well, it's a pleasure to welcome you after a gap of some few days of tax audit season. We had to stop the webinars and the physical programs for a couple of weeks due to festival and tax audit season for all of our members. Now we are back to the line of programs. Lot of programs have been lined for the month of October. We are having a national conference on forensic and disruptive technology on physical. I request other members to please mute on. It's a webinar. It's a not a webinar mode. It's a meeting mode. So we request you to please mute on. Whenever anyone wants to make, at the end the speaker will give you the chance to speak. So members, I was just taking you through the programs which have been planned for the month of October by Hyderabad branch of SIRC of ICI. So on 28th and 29th, we have a national conference under the aegis of Digital Assurance and Audit Board of ICAI, wherein a lot of expert speakers is talking on the new forensics and the disruptive technologies that is behind us for the future, which we need to adapt for our best possibility. And our ICI flagship program, that is MSME Yatra, is reaching on 27th to Hyderabad, wherein the bus will reach to Hyderabad, wherein we are having a joint program with Chamber of Commerce, which will help us to interact with a lot of MSMEs and members who are rendering services to MSME to give the interaction. And we are requesting the government delegates also to participate. And we are also having next programs, which the details are also available at the Hyderabad branch website. So thank you for the opportunity, Secretary, and looking forward for the next 2 hours of learning on the forensic management. Over to the Secretary.
Thank you, Chairman sir. Now I request CA Rajambal madam, Management Committee member, to introduce both of our speakers today, Siddharth Khare sir and Abhishek Gaur sir.
Thank you, Ravi Shankar. A very good evening to one and all once again. And the topic is very interesting. First of it, we do a very few of it, these kind of programs, and I'm really very thankful to our distinguished speakers today who have agreed to come and enlighten the delegates with the knowledge. Thank you so much in advance, sir. Our first speaker is Abhishek Gaur. Mr. Abhishek is associated with the National Stock Exchange for the last 8 years, designated as Senior Manager handling business development portfolios for the Southern region. He's done his MBA Finance from ICFE University, BCom from Osmania, and has worked in the finance market space for more than 15 years. He's got rich experience in the vertical of capital market, index, stock derivatives, forex, interest rate, risk management, fixed income market, mutual funds, so on and so forth. He's also done a listing of a few SMEs on the SME exchange. He's been engaging with the corporates to guide them on managing the forex risk and help them raise funds through alternate mode of finance, that is listing on the NSE SME platform or through an IPO. Welcome, Abhishek sir. The second speaker for the evening is Mr. Siddeshwar Khare. Welcome, sir. Siddeshwar sir is a young professional with master's degree in finance from Mumbai University. He brings in around 10 years of experience into extensive research in global commodities, currencies, and specializes in corporate foreign exchange risk management. He's been instrumental in setting up the FX risk management system for corporates in his assignments. Well versed with handling treasury operations for corporates and has exposed close to worth 2,000 crores in Indian rupees. He's also been adding value to small and medium-sized organizations across industries. At his previous stint with India's renowned broking and risk management service provider, now he's associated with Phillip Capital and heads the FX research and risk management division of the company. A very warm welcome to both of our speakers. Thank you, sir. Back to Ravi. Yeah, I think the audience is all yours. Yeah, we can just get started with the session, sir. We are around.
You can take it up.
Yeah.
Siddhesh, please go ahead.
All right, sorry, I was muted. All right, so to start with, I would want to share my screen with the presentation first. Firstly, thank you very much, SIRC, the team at SIRC for allowing us to participate in this webinar session wherein we can showcase the details on foreign exchange risk management to all the chartered accountants that are present in this today's session. All right, to start with, I'll give a short brief introduction about my company, Phillip Capital India Private Limited, which was established in 1975 and as the Phillip Capital Group, and it has started its operations as a financial services company, Phillip Securities, at the time of inception. And later on, Phillip Capital is an integrated financial house with global presence around across 16 countries that offers a full range of financial services to retail and corporate clients. So we have an asset under management more than $28 billion as on date, and shareholders funds in excess of $1 billion. We have more than 1 million clients across the globe in those 16 countries that we are operational. Phillip Capital basically is as I said, is a non-banking financial services provider wherein we provide various investment avenues, various investment products for our clients, and one of the important products is into equity markets and trading into equity markets and commodities markets. So these are few exchanges that we are registered with. In America, we have registered with NASDAQ, NYSE, and Amex, and with UK, we are at the London Stock Exchange. Similarly, in Asia with Singapore Exchange and Japan Exchange, Taiwanese Exchange, and even Hong Kong Exchange. So also, of course, in India, we are registered with both BSE and NSE. Now coming up to the currencies markets and foreign exchange, that the topic we are dealing with today. So just to give an overview of the currency markets, that these are some numbers that I would like to bring to your notice at the start of this session, and which is talking about the share of global currency into the world trade and the liquidity in the asset class and everything. So currency markets is one of the largest and most liquid asset class, if we see to it in that way, as compared to bond markets and commodities markets and equity markets. So currencies markets is the biggest and most liquid market. It has a daily turnover which exceeds $6 trillion, and the major trading centers in the world are London, New York, Tokyo, and Singapore, which contribute to almost 70% of the global forex trade, currency trade. So also in the currency markets, we have spot, forward, and futures and options and various other derived products from the exotic products that are derived from the forwards and options. So we have OTC markets as well as exchange traded currency derivatives across the world, wherein you can, most of the retail participants come to the exchanges to trade on the currency markets, or even a large share of corporates that come to exchange to hedge their currency risk. And similarly, there is the over-the-counter OTC market, wherein those corporates also hedge their currency risk and book forward contracts and options, use options books with the banks to lock in their, to hedge their currency risk and lock in their prices. So looking at the currencies market as whole, it's a huge market with lot of, lot of momentum and drivers that drive the market on a daily basis. So there are some major factors that I have listed down in today's session, which I would like to highlight you. The most important factor that affects the exchange rate of a country is obviously the central bank's interventions. As we talk of it today, there has been a lot of intervention that we have seen in the past few days from the RBI to control the volatility in the currencies markets after the Federal Reserve and all other central banks have started raising their interest rates to tackle the inflation in their countries. There has been a lot of volatility in the bond markets and currencies markets. So there has also been interventions from various banks. Recently, we had seen intervention from the Bank of Japan, which had intervened to protect Japanese yen from further depreciating against dollar. And this was after, I think, almost after 30 years that the Bank of Japan had intervened. So central bank intervention, of course, plays a major role. But on a day-to-day basis, when we look at the currencies markets as to what is driving the currency markets, apart from the demand and supply, obviously, because demand and supply is the core to any sort of exchange that happens, either it is equity or commodities or currencies or bond markets, whatever. But there are those fundamental factors that play a very vital role in the forex markets today, and most of these fundamental factors are directly coming from the US, and US dollar being the global currency. Most other currencies are, the performance of most other currencies is directly linked to the performance of dollar. So as an analyst or as a trader or as an investor, when you look at the currencies markets, the first thing that you want to understand or want to notice is the dollar index. Now, this dollar index is directly dependent on the fundamental factors that are the economic data points that are released or the economic conditions in the United States. So economic data releases from the US are of the most of utmost importance for any trader or an investor, be it in any part of the world. It is these data points are of the most importance for any analyst or trader to understand the markets. So fundamental factors, obviously, like talking about macroeconomic factors, maybe GDP and inflation numbers and PMIs, purchase manufacturing indices, all those numbers. Then microeconomic, let's say maybe weekly unemployment claims that are reported in the US, the retail sales data, the housing market data. So all these economic data releases in the US, in the Eurozone, in the UK, in Japan, in China are the major drivers that drive the global foreign exchange market. Indian economic data points are of importance, but do not contribute to global foreign exchange. Obviously, economic data releases in India will definitely affect the Indian rupee. But as I said, most of the currency markets are driven by those major currencies: US dollar, euro, Swiss franc, Canadian dollar, British pound, and Japanese yen. So these are the major currencies, not only important and major currencies, but most of the trading that happens across the world is happening in these 6 or 7 currencies. That's why these currencies are called major currencies. And all other currencies come into one group, be it Arabi dirhams or Australian dollars or Indian rupee or Malaysian ringgit, Thai baht, South African rand. All those currencies come in other group, which we would say as a minor currencies group, which do not contribute much to the world trade. But yes, of course, for that particular country, their currency is obviously important. So when we track Indian rupee, we also have to consider all those economic data releases in India as well. Like we track CPI, we track WPI, we track IIP numbers, we track GDP numbers, we track growth forecasts that have been released by Fitch and Moody's and any other rating agency. The ratings that the sovereign ratings that they are giving to countries, giving to India, that also affect the markets on a larger scale, I would say. So, but domestically, I would say, as a layman, when you track currency markets, the first thing you will do is you will link it to the performance of the equity indices, the Nifty or the Sensex. So on a normal day's course, when you see if the Nifty is rising, you would see the rupee appreciating. So USD INR dropping. And the main reason behind that is, as we talk, we say that there is inflows into the Indian equity markets when there is an FPI or FII investment that happens in the Indian equities. Equity markets rise, and because there is a supply of dollars that is coming into the Indian markets, rupee is strengthening because there is more demand for rupee to be invested into the equity markets. That's why rupee strengthens. So on a normal day when there is no war happening, there is no COVID happening, there is no inflation fears in the market, there is no recession fears in the market. In such a normal school market, we would see that when there is an inflow of foreign currency to be converted into domestic currency, to be invested into the domestic equity markets or bond markets, in the debt market or capital markets, we see that the domestic currency is appreciating. So that is one aspect of demand and supply that we, as a layman, we talk on a daily basis. So the first thing, when you look at the currency market or the USD INR price, you look at the Nifty or Bombay Stock Exchange, and then accordingly, you try to analyze what is the trend in the currency or the equity markets. But that is a very, as I said, it's a layman's observation, and now it does not hold very accurate in today's world, where there have been so many factors, like, as I have mentioned, political factors, policy decisions from the government. As we saw recently, the mini budget that was announced by the by the new British government. After that, there was a sudden sell-off in the bond markets, and the pound had depreciated very sharply from, I think, from 93, 94 levels. It had come down to 88 levels against INR. So within a very short period of, I would say, maybe 2 weeks, 10 to 15 days, in that much time, it had pound had depreciated by 5 rupees only because of the mini budget that was announced by the new government over there. So such policy decisions which affect the currencies market, as I mentioned, performance of equity market, performance of other peer currencies. How is Thai baht performing? How is Singapore dollar performing? How is Chinese yuan performing? Japanese yen performing? So these currencies also have a direct impact on the exchange rate of your domestic currency. Capital flows, I have already mentioned. Whenever there are capital flows into the markets, probably there are some block deals of L&T or Adani or any Navratna for that matter. So these bulk deals wherein there are huge investments coming into the Indian companies from abroad. In those cases, we see the currency exchange rate moving very sharply. Fundamental factors also I have mentioned. Most importantly, the fundamental economic data releases that drive the currencies markets come from US, secondly from the Eurozone, Japan, China, and the UK. So these are the major contributors to the currency movement. And any uncertain events like COVID and everything, even Russia-Ukraine war, I would say for that matter, has affected the currency markets. That was the first time in February, I'm sorry, when Russia, escalated this war against Ukraine. That was the first time I think USD INR had breached 75 levels, and now today there have been so many factors, the after effects of COVID and after effects of this long ongoing war that we have seen affecting the currencies markets, wherein the daily volatility, I would say, the daily movement in the currency has not been less than 50 or 60 paisa on a given day. So that kind of volatility has been there for the past, I would say, not less than 6 to 8 months that we have been seeing in the currencies markets, in specifically in the rupee market. Looking at the major currencies, Euro USD and GBP USD, or CAD USD, or CHF USD. There are not only these majors, but also the commodity currencies, maybe Australian dollar and USD. So these currencies also initially, earlier, where there was a movement of, let's say, 50 to 70 pips in a day's course, now it has extended 3 times to around 200 pips to 250 pips. So that kind of volatility is there in the markets. And when there is excess volatility, it brings huge trouble for businesses. And that is our next, next topic that we would be discussing. Of course, before that, there are some one second. Yes. So these are the when there is an excess of volatility, as I said, in the currencies, that is the biggest pain point for businesses who are doing international trade. And that is what is our topic today, to focus on, as to how do we protect those businesses from, or how do these businesses protect themselves from this kind of volatility that is going to affect their bottom line directly. So there are some factors, the risks that are there in the international trade. Obviously, political risk, as we have seen, has been affecting now. If we talk of energy as a product, if we talk of natural gas or crude oil as a product, which is directly affecting the trade, where Russia has stopped, giving gas to European countries. The Nord Stream pipeline has been was disrupted for a long time. Then it was under maintenance. So some or the other way, how political risk and war affects the trade of not only of currencies but also of commodities, also in the equity markets. So but when we talk about trade, it is specifically related to commodities and services. And this war of between Russia and Ukraine has definitely affected trade of energy products to between Russia and European countries, between OPEC and its allies and the rest of the world, between America and the rest of the world. So when we talk about crude and energy products, it is a basic necessity, natural gas in the Eurozone or in the US, oil for all sort of industries in every given country. So definitely political risk is there, civil disturbance, revolution, wars. Then there is commercial risk or business risk, as we talk of, which is disputes between buyers and sellers, customer illiquidity or insolvency, control of quality of goods. These are day-to-day challenges that any business faces when it is into not only international trade but also in domestic trade. Then there is documentary risk. Then there is, which includes this LC documentation, amendments of LCs, certificates of origin, bill of lading, all those things to be provided at time to the bank and all those things. Then there is interest rate risk, of course, which is nowadays having a big impact on the international trade, wherein, as we have seen for the last 5-6 months, there has been a rate hike spree that is going on in the world, wherein US has, Federal Reserve has raised interest rates, Bank of England has raised interest rates, RBI for that matter has raised interest rates, and every country, if you see, apart from Japan, I would say, have been continuously raising interest rates to tackle with the inflation problem that has come up because of the excess of liquidity during the COVID times, that the money that was pumped into the economy during the COVID times, that is affecting the markets now, which is causing this excess of inflation. And to tackle with, the central banks are trying to work out various strategies and raising interest rates to take the inflation down. Then there is foreign currency risk, which we are going to highlight today. And as I said, with the excess volatility that is there in the markets, foreign currency risk has become one of the biggest barrier to trade growth, to international trade growth today. And this foreign currency fluctuations risk, or foreign currency risk that is affecting the businesses, needs to be taken care of immediately, or otherwise, when there is an excess volatility, if my annual volatility in the currency is 8%, 10%, and if my business margins are 2%, 5%, 3%, I am completely wiped off with this kind of volatility. And that is why the trade growth is affecting, because it is not that the currency is depreciating or appreciating in one continuous direction. From a period from 1975 to 2022, if you see, obviously rupee has depreciated, but one cannot do business on such grounds that rupee will continuously depreciate. Today, if I do some trade, I'm not going to receive the money after 10 years. So it is a regular day-to-day process that affects my business. It is not that, because that is a mentality into exporters. Most of the exporters, who are second generation or third generation companies who are managing, they would say that no, we have seen for the past 20 years, dollar has been depreciating. Rupee has been depreciating, dollar has been appreciating. So we as an exporter do not need to hedge. It is always seen that dollar is appreciating, so we are always enjoying. But in fact, that is not the case. So this is the view of most of the exporters you will see into the markets who have been into exports business for a long time, as compared to vis-a-vis the new companies who have just recently started ventured into exports and started their export activities in the last 10 years or 10, 12 or 15 years. They would look foreign currency risk as they will give more importance to foreign currency risk as compared to those companies who have been into the business for 30 years, 40 years, 50 years. Because at that time, when they were established and growing at that time, the currency, first of all, did not have that much of volatility. Secondly, as I said, from 75 to 22, we have seen dollar continuously appreciating against INR, and that is what their view is, that dollar continuously appreciates. So we as an exporter do not need to hedge, but that is wrong, because today if you export, it is not that after 10 years you will be receiving that money. It is hardly a 40, 45 day, 60-day trade cycle that happens. And today, when you are exporting, what is the currency rate? And when you receive the foreign currency inward remittances, what is the currency rate when you exchange it and convert it into domestic currency? So these two rates are important. And that's why this has become a bigger challenge for companies who are into international trade, be it imports or exports, to manage the currency risk and come out of this risk safe and do focus on their business activities rather than investing time on foreign currency risk management. So of course, foreign currency risk, as we say, it comes from the fluctuations in the exchange rates. It has an impact on underlying FX exposures. As I said, if I am an exporter today, if I am an exporting, I have negotiated with my buyer to certain rate, whatever is my invoice amount, and based on that invoice amount, which is in foreign currency, I'll have to calculate while I'm negotiating with my buyer. I do my calculations in Indian rupee and accordingly quote my buyer in the foreign currency, let's say in dollar terms. So my calculation is happening in my head in the Indian rupee terms. My raw material, my labor cost, my manufacturing cost, my transport cost, my business profits, all these costs and margins that I club together reach a number. Let's say I would say 80 lakhs for some goods that I would be exporting. Now this 80 lakh is to be invoiced in dollars. So then I call up my buyer and tell him, okay, for these goods, I will raise an invoice of $1 lakh. Then he says, okay, you can raise this invoice, and then you start the manufacturing process. So your calculation is done in rupee. The invoice is raised in dollars. The rate that you used for converting that rupee calculation to dollar is the costing rate, which in this example, as we talk, is 80, let's say, for example. Now this 80 needs to be protected, because after 45 days, when I receive this 1 lakh USD in my dollar account with my bank, I need to convert it to Indian rupee to put it to use, to make some payments to my labor or to my suppliers of my raw material, whatever it is. So I need to convert this foreign currency to domestic currency. Now I go to my bank and I ask them, I have received 1 lakh USD in my dollar account. You please convert it into USD. At that time, if the spot rate is 79, bank says, okay, today's rate is 79. I can convert this 1 lakh to 1 lakh USD to domestic currency, to INR. In that case, my 1 lakh USD is converted to 79 lakh rupees. Whereas today, when I was doing this calculation, I had calculated at 80 lakh rupees. So there is straight away a 1 lakh rupee gap that is there when I receive this transaction amount. This is only because today when I initiated the transaction or raised the invoice, the spot rate was 80, which I considered to quote to my buyer. And after 45 days, the spot rate had dropped down from 80 to 79. And only because of this currency, adverse currency movement, which happened against me, I have lost 1 lakh rupee. Now this 1 lakh rupee is obviously a loss to me in my in this trade transaction that I have done. So it might happen that the USD INR spot rate could be 81 on that day. In that case, I enjoy 1 lakh rupee extra. So that kind of risk is there when we talk about foreign currency risk into actual trade transaction or international trade. Similar is the case with importers as well. When I am importing some goods from US or China or Eurozone, from wherever it is, I do they give me some quote. I use that quote to calculate how much do I need to pay in rupee terms. And then I calculate if that is a raw material, then that is my raw material cost, based on which my final products, finished goods selling price will be determined. In some cases, it is such a situation that I already have procured some sales orders from my domestic market for my finished goods, for which I require raw materials which are to be imported from US. In that case, I cannot change my selling price because I've already collected the sales orders. And what I can do is I can only negotiate with my seller to import goods from US, and whatever is the cost, I need to stick to that. In a case if USD INR appreciates, if USD appreciates against INR, and for that 1 lakh of dollars, if I have to pay more Indian rupee, then it again increases my manufacturing cost, which will directly affect my business margin. So it is both ways for importers as well as exporters that are affected because of the adverse currency movements. Whether it is 10 paisa, 20 paisa, 50 paisa, 1 rupee, 1.5 rupee, that does not matter. The time when the currency moves against you, you start incurring losses into that particular trade transaction. And that is where risk management comes into picture. Mitigating this risk, reducing, minimizing this risk becomes very important, because if in this trade transaction I lose, there is a pressure on me in the next trade transaction that I have to do. I try to recover this loss that has happened in this transaction in the next transaction. Now there is competition in the market. There are 5 other players who will be offering the product to my buyer at a cheaper rate, but I cannot. And that is how I tend to lose my business, let's say. Or there are maybe many competitors who are managing their risk properly, foreign currency risk, and not affected with this extra loss that I've done in my previous transaction. That is how my entire business gets affected, and slowly it piles up, and after a period of 1 year or 1.5 years, I see that I have incurred so much of losses because of the currency movements. So it is not that in the next 10 years dollar is going to appreciate, but I have to, as a businessman, I have to track every single trade transaction that I do individually, separately, and put in place some risk management policy or some strategy or some framework to manage this foreign currency risk. And that framework and this policy and everything is, we term it as risk management cycle or risk management process, foreign currency risk management process, wherein hedging is a part of that. Identifying the risk is the first thing that we have to do. Then measuring the risk is the second thing. How much would I be impacted if rupee moves against me by 1 rupee, 50 paisa? How much will it impact to my business margins, to my trade margins, to my bottom line at the end of the day? So these things need to be minutely observed and calculated. And then you come up with a risk mitigation strategy, implement it, and accordingly take care of this particular risk. Now in this, as I said, foreign currency risk is affected by it comes from fluctuations in the exchange rate. It has an impact on underlying FX exposures from my international trade. It also, there is a volatility and impact on business profits. As I mentioned, my business profits will not be, my margins will not be stable if I am not taking care of my trade transactions individually and identifying this risk and trying to mitigate it. So risk mitigation is important. To mitigate this risk, there is one tool or one strategy that is put in place, which is called hedging. Hedging is done to lock in the prices. As I mentioned today, when I am doing the calculations, let's say I am an exporter, I have a buyer from UAE who is buying my goods, and I am in a negotiation stage with my buyer. So I negotiate for some amount of goods at let's say 100,000 USD, 1 lakh USD, and that amount I have reached doing my calculations and everything. Right now, today's spot rate, let's say, is 80 rupees. 80 rupees per USD is the exchange rate today. Now, that is the rate that I have taken to quote my to my buyer. Now, if I receive less than 80, I am losing into that particular transaction. So the lowest that I can expect from this particular trade transaction of 1 lakh USD is 80 rupees per dollar. Anything above that is okay with me. Anything below that, I'm shrinking on my business margins. So to lock this 80, to lock this 80 price is hedging. To lock this price, the term used to lock this price is called, I hedge my inward remittance, 100,000 inward remittance at the price of 80. So hedging is locking in the pricing whichever you feel comfortable at. So ideally, I should lock the entire amount at 80 because that is what I expect. But as a businessman, I also tend to make a little more profit, taking an opportunity which the market fluctuations offer me. So then I decide to lock only 50%, hedge only 50% of my exposure. Remaining 50% I keep open, $50,000 for some dollar appreciation in the next 2 days, 3 days, maybe 80-30 or 80-50. So that extra, that 30-50 paisa is my extra earnings on the per dollar on the trade transaction. Also at that moment, I also keep a downward risk limit that I am ready to take. Today I've locked in 50,000, remaining 50,000, I can take a risk of 20 paisa or 30 paisa. So if the dollar INR price drops down to from 82 to 81.70, let's say, I will immediately book the remaining 50,000 also. I don't wish to incur more losses in that particular transaction. So 81.70 is my risk limit, and 82.30 is my target rate for that remaining 50,000. And that is how I do my day-to-day hedging activity. Now, of course, this risk appetite and target rates change company to company, trader to trader, analyst to analyst, and accordingly the markets move. So, but what we are focusing here at is the business margins that need to be kept intact while we are not losing on the currency, because currency movement is not our business. Our business is different. We need to invest most of our time into our business and not try to earn or make money from Forex movements. So that should be the approach of companies, and that is how you will put in place a better risk management policy. Coming to areas of impact because of the currency risk, obviously financial perspective, which is a direct impact on your bottom line because of, as I explained, how does the revenues get affected and how does the profit margins also get affected. From the business perspective, there are two things: orders with frozen pricing and orders with open pricing. Now, orders with frozen pricing, I had just a while back, I had mentioned that if I am an importer of raw materials, wherein I would be importing only when I have some orders at hand, some sales orders in domestic markets at hand, based on which I will see as to how much raw material I require. And then I will place order with my seller in the US to buy that raw material. Now, in this case, when I already have sales orders in my hand, I definitely must have quoted the final rate to these domestic buyers of my finished goods. So I cannot change that pricing. That is called frozen pricing. So orders with frozen pricing, wherein my sales price is fixed, but my raw material import price is, might get affected because of the currency movements. And orders with open pricing is day-to-day business. Like today, when I am exporting, what would be the rate? Then I try to lock in that rate based on my calculation. As I said, 82 is today's rate, for example. I want to lock in because this does not have anything related to my manufacturing cost or import cost or import of raw materials cost. My selling price will be defined later when I have inventory at place, when I have stocks ready to be disposed, to be sold, or to be shipped. At that time, I am negotiating with my buyer to sell my goods. That these orders are called orders with open pricing. So these are the areas of impact wherein the currency price movement will have a direct impact on the businesses. And now the most important thing that we are talking about is the need to manage this foreign currency risk. it protects you against the adverse exchange rate. When you have locked your price at 82, no matter tomorrow after the 30 days when you are receiving the foreign currency inwards, whatever may be the rate, either it is 78 or 85, you are not concerned about it. Today, when you are locking in the price at 82, you have safeguarded yourself from any movement in the currency, either positive or negative. So you are then focusing on your day-to-day business rather than investing time on the currency fluctuation. So that is one thing. You can also project your operating profits in this case when you have already locked in your pricing, be it for imports of finished goods or raw materials, exports of raw materials or finished goods, or services. When you have the final price in place, you can project your operating profits based on that. You can also be competitive enough if your risk management policy is such that you have made 50 paisa out of one transaction this month. Probably you can offer your buyer a discount, or offer your products at a competitive rate as compared to your peers, the other sellers to your buyers. So in that case, this 50 paisa, you can pass it on to your buyer. You can offer him at a cheaper rate and collect more orders. So that way also, if you look at it, you can, that can result into increase of your trade volume. So that is sustainable business and growing your business, also achieving your budgets and targets. And in a competitive market where you are managing your foreign currency risk well as compared to your competitors, you will definitely have an upper hand when you are doing business with your doing business along with your peers. So that is how important this foreign exchange risk management in today's world, which can have a direct impact on your growth rate, your competition, your budgets and targets, and of course your bottom line. Okay, so this is the methodology, which is more of a technical thing. I think what I have done is, while having this session, I have covered most of these points, and I'm just running through the slides that I have prepared so that you can just identify what we have discussed till now. So risk management methodology, as we see, is identifying the risk, measuring the risk. Now there could be various approaches to measure the risk. There could be some statistical approaches. There could be some technical approach based on trend analysis and trend forecast on the currencies. There could be some there could be an approach wherein you consider the fundamental factors, the economic data releases, the macroeconomic data, the microeconomic data, to decide and to measure the risk as to how much it will affect your business margin in that particular stipulated time. So risk measurement is a vast area wherein you can do a lot of permutations and combinations. You can put statistics to use. You can do VAR calculations. You can do multiple regressions and all sort of statistical tools. We have ARIMA. You have ACF, PACF tools. You have basically lots of statistics that can be put in place and come up with a risk measurement methodology. Then there is benchmarking the transaction. As I said, when you are entering into a trade transaction, the calculations in your head are in rupee terms, while the actual invoicing happens in foreign currency. So that calculation and the invoicing, the conversion rate is the benchmark rate or the costing rate that we as a risk manager should protect in every single transaction. Anything above that rate is an added advantage that the currency fluctuations offer to us. Of course, there is controls and reporting. Reporting is one of the most important factors when you look at your quarterly growth or your year-on-year growth in your company. So in these things, when also not only from the growth perspective, but also on day-to-day management of foreign currency risk. When there is a proper reporting in place, when you know that how much of your total monthly exposure is being hedged, how much is unhedged, what is the risk on the unhedged exposure, what if the currency moves in adverse in opposite direction by 1 rupee, how much will I lose on that unhedged portion, how much will I gain on that unhedged portion, what should be my risk limit, what should be my trade target. All those things, when you have in place in that particular report, as a decision maker of the company, you are in a better place to make such difficult decisions when there is proper reports in front of you. And of course, risk mitigation, putting everything that you are doing into place. And
మనం అనుకోలేదే అరే నువ్వు నేను గరిమా వెళ్ళిన సినిమాకి వీడు నేను గరిమా
I think there's some disturbance. Yeah, so risk mitigation also is the it's the end product of all that you have been doing to protect the business from the foreign currency risk. After that, what I would like to highlight is some principles on hedging. When these are the principles that decision makers should implement while deciding on the hedging strategy or anything. So these are I'll just read it out because it is just in simple plain language. We must make profits from our key business activity and not try to make profits from the currency fluctuations. We also need to monitor and understand the risk. Hedging or trading in Forex is not the main business activity, right? So hedging, then again opening the hedge, then again putting hedge into place, again locking the forwards, again when you are into profit, canceling the forwards. That is not the business that you are into, right? Then the business needs to have a stable Forex policy, which is a must in today's situation where there is excess of volatility into bond markets or interest rate markets or currency markets. Then you cannot sell at peak and buy at bottom. That is also an important. Every exporter will want to lock a forward contract at the highest possible price. 80 to 50 when I sell dollars with the bank, when I book export forwards, the dollar should come down. It should not further go up. That is what exporters think. Importers will think, if I buy import forward dollars at 79.50, it should not further go down. It should continuously move up only. So that will never happen. You cannot catch the highs and lows in the markets, right? Then the objective from the risk management policy is to protect the business margins. And this is the most important thing that the risk manager needs to keep into mind when you are advising the company or when you are executing your risk management policy as a CFO or a general manager finance or even a CA for that matter. So we also need to take calculated risk and not blind risk. So whenever you are setting the risk limits and target rates, it has to have some concrete base as to why you have set this rate as a risk limit and this X rate as a target rate. There has to be some logical answer to that question, right? So these are some principles for hedging. And now coming to another important topic for today is the exchange traded currency derivatives, which is as compared. Oh, I'm sorry, 1 second. So exchange traded currency derivatives in India with NSE futures and options, wherein you can, as a trader or as a hedger, you can use exchange traded currency derivatives, the platform that is provided by NSE, to hedge your foreign currency risk, uh, on the exchange platform. But compared to forwards, there is not much of companies, not many companies who are using exchange traded platform as as a platform to hedge their currency risk. But this was a picture way back in, I would say, 2012, 13, or between 2012 and 2015. But after 2015, 16, there has been a continuous rise in trade volumes at the exchange platform. The reason being, these are a few reasons that I have jotted down. But the most importantly, what I would like to highlight over here is, of course, forwards and futures are technically same. There are some differentiation points in that based on the maturity and everything, which I believe Abhishek would be covering on that. But there are some technical differences in forwards and futures. But on the executionary part, as a CFO or as a decision maker or as a MD of a company who is looking to hedge his currency risk, I don't think there is much difference in forwards and futures. In fact, futures is more cost effective, looking at the margins that are being charged, looking at the spread that is being charged. So all these things definitely, I think, will be highlighted in the session going forward. I'll just take a couple of minutes to highlight some points that I thought should be shared at this moment of the session. So comparison between forwards and futures, price transparency is the biggest factor. You don't know when you call up your bank dealer to lock a forward or do cash convergence. You don't know what is the rate actually. On xe.com or Google Finance, Yahoo Finance, you will see some spot rate, but that is a lagged rate. That is not the live rate. 10 minutes difference, 15 minutes difference, something of that sort will always be there. So that is not an accurate rate. Also, on these free websites, you will see only the spot rate. You don't have forward rates, 1 month forward, 6 month forward. These rates you will not be able to see on these free platforms. So banks will quote you with their own business margins. Now, when we deal with our clients, we see that for one client, it is just 2 paisa difference. For some client, it is 20 paisa. For some clients, it is 50 paisa. So that much of difference is there still in the markets, because ours is just an evolving, in terms of international trade, we are not that great. If you compare with the developed countries, we are, I would say, we are nowhere. So we are not that much into international trade. And that is where banks are exploiting those companies, charging margins, because there is no price transparency. You do not have a platform where you can check the actual rates and then call up your bank and negotiate, saying that, okay, this is the live rate right now. Why are you quoting me this rate? So you give me something close to this rate. That you cannot see. Whereas with the futures, all those rates are live and in front of you on the screen when you are buying or selling dollars. You can take a reference of these rates and negotiate with the banks, but banks will not agree to that, right? Because these are so price transparent, the futures rate, that there is hardly quarter paisa or half a paisa, not even half a paisa difference between the futures rate and the actual OTC markets rate. Only a quarter paisa difference, but that difference is between the bid and ask, and banks will never give you the rate that is directly quoted on the OTC markets, because that is not even the rate that the banks will get when they are buying or selling dollars to another bank. So between interbank dealing also, there is an IBR, interbank rate, right? Which is over and above the rate that is displayed in the futures market. So over and above that, the bank will charge you margins. So that is the difference between futures and forwards when it comes to price transparency. Margins and brokerage, banks will charge you anything between, as I said, 2 paisa to 50 paisa. In euro and pound, it is more than 50 paisa, 80 paisa, 70 paisa, like that. But on the exchange, it is hardly, quarter paisa to 3 paisa is the brokerage that any exchange platform provider like Phillip Capital will charge you. Spread, bid and ask spread on any given time in forward contracts, if you see, will be not less than 2 paisa. Whereas on the exchange, it is only quarter paisa. So that much of liquidity is still there in the futures markets on the exchange traded platform. Market timings with the bank, it is 10 to 2. It is 9:30 to 2, but actually the bookings will start, most of the bookings will start by 10 o'clock only. So, but definitely it will end at 2:30 or 2:30 or 3 o'clock. So, but with the exchange, you even during the COVID times when the RBI had shortened the trade timings at the banks, exchanges were fully running in the 9 to 5 timing. So there has been no change in the timings with the exchange. It has been 9 to 5 since the beginning. Options contracts, very tough documentation and restrictions, ISDA guidelines and master documents and everything. Whereas to avail the options platform with the bank, there the margins will be even higher than forwards. But still, even if you want to do options with your bank, looking at your high volumes of business and everything, still the documentation and everything will be very tough, and there will be a lot of ISDA restrictions and RBI restrictions, FEDI, FEMA restrictions that will come into picture. Whereas with the exchange, it is very simple. It's the same KYC that is being done while you are opening an account on the exchange traded platform. And there are no restrictions as such from any regulatory body. Contract sizes, here on exchange, it is fixed. It is $1,000 or £1,000 or €1,000. And in JPY, it is, I think it is 1 lakh JPY. Documentation, as I said, here with exchanges, it is pretty simple. It is just the basic KYC documents. And with the mark to market that is to be done on the forwards, on the OTC markets, it is a periodical task. Only when your collateral is falling short of what you have lost on the forward that you have booked, the banks will ask you for the margins. But here on the exchange, it is daily mark to market. So there is no liquidity crisis in the company or cash flow mismanagement in the company when it comes to exchange traded derivatives, because it is mark to market on a daily basis. Liquidity subject to credit limits. If I am a small company with only forward limits sanctioned up to, for 3 months period, up to $1.5 lakh only, I cannot exceed that. Even if I have some bulk orders due to some festive season or something, I cannot change that. Whereas with futures, the liquidity is high. You can book as much as forward contracts as you want, futures contract as you want. And the settlement also is cash settled with futures, whereas with the forwards, it is a physical delivery. So that is one challenge that will always be there, because when the money comes and is transacted, it is transacted in the banks only and not with the exchanges. So physical delivery will be, I would say, is a plus point to traders or to businesses, because that is an actual conversion of foreign currency to domestic or domestic to foreign currency. Whereas on the exchange, it is settled in the domestic currency. It is cash settled. To hedging, to use it as a hedging tool, definitely futures is useful. So whenever you hedge and whenever you receive that foreign currency and whenever you do the conversion, simultaneously you can cancel this futures contract on the exchange and do the netting off with settling off in INR, whatever it is. So these are some differences. Now I would, that is all from my side, people, and I would ask Abhishek to take it over from here. And thank you very much, everybody.
Abhishek sir, now floor is yours, sir. Thank you, Siddharth sir.
Thank you very much, sir. Thank you. Thank you very much.
Abhishek sir, unmute please.
Thank you for that very common issue basically when we are going virtual. We never know whether we are heard or not. Thanks for the point. At the outset, actually, I would like to extend my thanks to the Southern Indian Regional Council of the Indian Institute of Chartered Accountants, and in specific, Mr. Deepak Laddaji, who is the chairman of the ICAI Hyderabad branch, for giving me this opportunity to interact with all of you and share details about a particular segment, which is, though yes, very important in the life of a professional, because you interact with a lot of businesses, and you, most of the time, whether thoughtfully done or not, you basically act as their advisor or probably a well-wisher who would always help them in managing the businesses and subsequently in a large context on their finances. So being from the financial industry and also handling a few products which are most important for the MSMEs and the businesses, I would actually extend my great thanks to the branch of ICI for giving us this opportunity to talk. And before I again begin, I would like to say Siddesh that his address about the concept of hedging has actually made a very smooth going for me. Hopefully, I'll not be having many bumps and making people understand how hedging is important and how things are to be looked at when it is to be looked at with an alternate mechanism which is available on the exchange platform. Largely, people have been doing hedging, or corporates have been indulging into Forex hedging through booking forwards in the banks and the OTC market, to be very precise. This new platform, yes, we call it new because it is relatively new compared to the existing market. But yes, it also had its due presence, which was there since 2008. This market is live, and people have been participating into it very actively. To sum up in terms of the participation, though it is less compared to the global scenario, but on an average, we are clocking at around 55,000 crores in terms of futures volume. Now, options volume is also there, but the notional value I'll not be able to immediately calculate and tell you. But in the terms of futures, which is in absolute Indian rupee terms, it is to the tune of around 55,000 crore rupees, which we have done in the last trading session, and it has been averagely doing on that side only. So it's largely acceptable market with a large number of participants on board, and it's doing good. We are expecting it to be more adaptable to the industry, so that they get an alternate, or probably they can also look at an alternate to repeating upon their requirement of hedging at any given point of time. So before I get into the presentation, I would like to showcase a few charts for you, so that it becomes easy for you to understand how the currency plays a very vital role in terms of how to manage the finances, and subsequently how to run a business if there is an import and export transaction happening in the business. So if we look at this particular screen, we are able to see that Indian rupee is $1 is equal to 82.42 Indian rupees. This is what the chart is, and subsequently there is a chart beside this. If you look over here, there has been around a 1 year period, and in this 1 year period, the currency is hypothetically moved from 55 rupees to almost 83 rupees. So now, if I talk about scenarios which were, say, 4 years or 5 years down the line, or probably previous, not down the line, in fact, the previous 4 to 5 years, you never had seen such a kind of a volatility in the market, in the currency market, to be very precise, because this fluctuations have come so dynamically that it is always impacting both sides of the participants on both the sides, be it on an import side or on the export side. Everybody is getting impacted because nobody can predict what is the day at which the receivables or payments are due, and then subsequently at what rate, the reference rate, the currency is either coming in to India or going out of India. So it becomes very, very, very important, and the current level of volatility is actually pushing people to think on using this platform in a very dear way, so that they can protect their benchmark. So that is more important. If you are not protecting your benchmark, then you are not able to manage your business properly. End of the day, it is impacting the cash flow. So you'll have to be very precise in terms of protecting the benchmark. I'm not talking about getting profitability of the currency fluctuations. The main benchmark or the main objective of hedging is protecting from the currency fluctuations which are impacting your cash flows. Now, this is only USD INR which I was talking about. Let us try to see few more currencies which are more accepted in Indian business context. This is Euro. Since a long time, we have seen that Indian rupee has been depreciating and the foreign currencies have been appreciating. Now, in the last 1.5 years, the trend has almost changed to some extent. The dynamics are now changing. Indian rupee is appreciating against some currencies, whereas depreciating against some currencies. So if you are having an exposure to different continents or probably different countries, then you have to definitely pull up your socks and try to understand how to manage that risk, because this animal is definitely very dynamic, and people who don't have an understanding of foreign exchange markets, they definitely are affected, and that effect is definitely a very dear effect. Now coming to another very prominent currency across the globe, which is the Great Britain pound. Let me just check where it is. So yeah, so this is pound for you. That is a Great Britain pound, or in general terms, we call it as GBP INR, the reference rate which is visible. So it was trading somewhere around 100 rupee a pound. On the lower side, just a few days back, it was trading at 87 rupees per sterling pound. So if you look at this fluctuation and see the chart, the way dynamically the charts are moving, it is definite that many people who would have expected that Indian rupee always depreciates or Indian rupee or the foreign currency always appreciates, they definitely had a very difficult time to manage their finances. So before I get into the presentation, I wanted for you all to look at this charts and keep few things in mind, that managing this currency fluctuations is definitely one of the business activities. It is not a foreign activity which people or businesses can overlook and allow the market to react accordingly. Don't ever advise anybody on that side, because it is definitely a kind of a animal which is very volatile and very dangerous for businesses. So with this, I'll get to my presentation. So just confirm me whether you're able to see the presentation and confirm me, please.
Sir, it's presentation coming nicely, sir.
Oh, thank you for that. So today I'll be talking on the exchange traded currency derivatives. So by the word derivatives, yes, it is a derivative contract, and anything traded as derivative on the stock exchange are always futures and options. So in currency also, we had started with the futures and options since 2008, and since then it has been very adaptable. Many corporates have now started getting into it, both on the big as well as the small sized corporates. They have accepted it, and they are going ahead in their accepting this as a part of their activity in the financial risk management. Now, in the presentation, I'll be covering the currency pairs, then coming to the trading system, how it happens, how the settlement happens, doing some touching points on the risk management, and then on the participants who are generally active in the currency market. And then I'll take a leave from your discussion, and then we can have a question and answer sessions if you have anything. So before getting into it, I'll quickly run through a few points which Siddesh would have left in the last slide, which he was talking about the forwards market as well as the exchange market. In terms of participants, the exchange market welcomes all type of participants, be it from the trading members, that is the stockbrokers, foreign portfolio investors, banks themselves do it on the exchange, corporates, be it importer or exporter, or retail individuals like you and I, whoever are feeling that we are impacted with the currency fluctuation in any terms, all the participants who are there within the country can participate through the exchange traded currency derivatives platform and manage their currency risk. Whereas on the OTC market, there are specific participants, that is AD1 category, AD category 1. Bankers are there who are again specified by RBI. This certification is definitely given by RBI to them to participate, and subsequently their client, that is the corporates only, who are having the reasonable exposure on the Forex side, they participate on the interbanking market or the OTC market. Liquidity, which is already touched upon, on the OTC market, the credit limits are assigned by the financial institutions, whereas on the exchange, whatever margins are required by the exchange, whoever puts it, they are allowed to participate in the exchange market. So thereby it is a credit agnostic market. We don't specifically say that somebody is more credible than another. So it's a uniform platform for all. The accessibility is relatively low in the OTC market because the type of participants there, that the accessibility is less, and subsequently anybody who wants to understand the currencies market on the OTC side, it is relatively different until unless somebody doesn't has an exposure. Whereas on the exchange platform, whoever wants to understand the currency market, whoever wants to participate into it, or whoever wishes to see that if they are able to protect their benchmark price in their businesses on the stock exchange, they can definitely come and they can start participating on the exchange. On terms of credit exposure, the OTC counterparty risk lies with the bank which the entity is hedging with. So within the banking market, so when banks do hedging among themselves, trading among themselves in the currency, that is called the interbanking market. The corporates go to the bank and they're forward. So on that side, the bank who is in the middle, who is the touch point for that entity, he is the he's the counterparty, and then subsequently there could be a possibility of a counterparty risk in that situation. Whereas in the history of a stock exchange where the clearing corporation has taken over the activity or the responsibility of clearing all trades, so the clearing corporation guarantees all the transactions on the stock exchange. Transparency is relatively low in terms of pricing and in terms of process, whereas everything is crystal clear and it is a screen trading trade platform, whereas the exchange traded currency derivatives is concerned. Specifications for the OTC market, the contract specification depends on the individual, on the need of the individual from time to time. Whereas on the exchange, there are a set of rules which are already written, and everybody whoever wants to access this platform comes with that standardized rule, and then they can participate. Margins, it's already been covered, so there's no M2M on the OTC side, whereas yes, there are margins as well as in mark to market, which is applicable on the exchange side, which most of the time becomes handy for the corporates over a long period of time. In terms of beneficiaries, the large corporates are better beneficiaries compared to the smaller participants because of the spreads, because of the visibility, because of the accessibility, and so on. Because the big corporates can invest having an infrastructure to manage a proper treasury desk vis-a-vis a small corporate. Yes, the biggest difference between OTC market and the exchange traded derivatives market is the last one, deliverable of the currency. So on the exchange, as it is an exchange platform and we are not into exchange of currencies, it is purely a cash settled contract or cash settled platform where the difference of the hedging point to the square of point is taken or probably given depending upon the situation or depending upon the transaction situation. Whereas on the OTC market, the transaction converges into physical delivery and then subsequently trades get settled. So on the exchange, if somebody is doing it, they'll have to settle it on the exchange and subsequently go to their financial institution and parallelly ask them to convert that currency into the foreign currency and then subsequently do their remittances or receive their payments accordingly. Now, understanding what type of pairs are available in Indian currency, because Indian scenario. Before I get into this, I'll try to mention that this currency derivatives platform is a platform which is regulated by SEBI because we fall under the capital markets domain, and subsequently along with the SEBI, even the RBI also plays an active role in terms of regulating the market. So all the approvals which are to be given for a pair of currency or for any kind of a transaction on the stock exchange in the currency derivative segment, along with the SEBI's approval, observation and approvals of RBI is also generally sought, and then only the products are launched. So in terms of currency pairs available on the Indian exchange traded derivative market, we are having 7 pairs which are basically categorized into 2 different categories. One which we generally call as the future currency versus Indian pairs. In that, the one side of it would be termed as INR and the other side would be termed as the foreign currency notation. Now, what it is, how to understand that, we'll definitely take it in the subsequent slides. But this FCY-INR pairs are basically the INR, that is Indian rupee based pairs. Whereas there is another set of contracts which get traded on the Indian exchange market, which is called the cross currency pairs or the future currency to the foreign currency to foreign currency pairs, where the quotations of of the currencies of 2 different countries is taken into account, and subsequently transactions happen in that same way. So in that sense, we have Euro USD, British Pound USD, as well as USD and Japanese Yen. So these are the currency pairs which are available. Though yes, these are the 4 future currency and Indian pairs available in the Indian exchange market. Generally, it is told that 88% or probably more than 85% of the transactions in the foreign exchange transactions across the globe are happening in the USD terms. So that is the biggest currency, and that is how it is the largest traded currency across the globe. Now, getting into the trading aspect of it, trying to understand how the trading scenario is available and how generally a participant needs to look at it. It is a screen-based trading platform where anonymous order bidding and order matching happens. Order matching on the exchange platforms happens on the price and time priority basis, which is dynamic and which is very conducive and very secure. It's an internal risk management platform. So the risk is also done internally, and it's an inbuilt activity. There are multiple connectivity options. So these days, everybody is looking at things on the move. So the exchange scenarios or probably the infrastructure which the exchange scenario helps or probably enables is that you can also look at the prices live on your palm tops or probably your mobile phones as well. Multiple trading platforms are also available, and then the market information is wide and it's already accessible to the participants, whoever wish to secure to understand their exposure and their risk. Coming to the currency pairs, which we have understood in the previous slide. When we look at the currency pairs, so when we talk about USD, how much a USD comes in terms of Indian rupee, we call the term as USD INR. Now, what does that specifically mean? How do you understand that? What is the significance of that? So you understand that, so there are 2 terms of currencies used there. One is USD, that is the US dollar. Another is the Indian rupee, which is INR. So why specifically that it is mentioned is, one is a base currency, another is a quote currency. Base currency is a kind of a currency which is the transacted currency, and the quotation currency is where the quotation comes from. So if we talk about USD INR and we say that it is 82 rupees 30 paisa, 82 rupees 45 paisa, that means 1 unit of US dollar is equal to spending 82 rupees of Indian currency. So the USD becomes the base currency and the quote currency becomes the Indian rupee. So that is how the USD INR phrase has been incorporated, and that is how the base currency and quote currency is to be understood. Now, in terms of contract sizes available on the exchange platform, for the future currency to Indian rupee pairs, we are having the 4 contracts which are available over here on the top, where USD INR starts with 1000 USD. So multiples of 1000 USD is what an individual or a corporate can hedge. Similarly, for Euro and Great Britain Pound, it is 1000 units of the respective currency. That is the base currency, Euro or GBP. Whereas on the Japanese Yen, it is 1 lakh Japanese Yen versus Indian rupee contracts which are traded on the future currency to INR pair, that is FCY. Now coming to the cross currencies again, all the contracts are starting with 1000 units of that respective currency. So euro, it is 1000 euro in euro USD, GBP, it is GBP USD, it is 1000 GBP, and USD JPY, it is 1000 USD, which is getting transacted on the exchange platform for the participants to use for their hedging purpose. Now, understanding the tick size, Siddesh in his slide was talking about the tick size or probably the spreads which are available on the exchange platform vis-a-vis the forwards market. So this is what he was talking about. For the USD INR pairs or probably the future currency to Indian rupee pair, the tick size or the transaction size for every step positive or every step negative in terms of movement is quarter of a paisa, that is 0.0025. So there's 4 decimals which are getting traded on the currency pairs for these currencies. This is called BIPs, and then subsequently for the cross currencies, the Euro USD and GBP USD, it is 0.0001. So if you look at the steps which is basically given over here for you to understand on the indicator side, it is say somebody's taken a position as an importer at 81.1050, then any positive movement in his favor would be 81.1075. So that is 0.0025 plus, and then subsequently on the negative side it goes 1025. So this is how the currency market on the exchange platform works, and it people generally indulge into hedging and trading into currency derivatives platform in this fashion. Understanding the contracts available on the exchange platform, as we talk today, we are having around 12 serial monthly contracts on the futures, and subsequently 11 weekly contracts for participants who are looking at very short-term kind of an exposure to hedge, or probably for individuals or people who want to trade into currencies. They basically can use both the expiry level contracts for as suiting their requirements. In terms of apart from futures, we also have a product which is called options. Again, a very unique platform, unique product which is available on the exchange, which is hitherto not available with most of the participants in the OTC market, where people can use this platform or this product to manage their currency risk, even if they are looking at taking advantage of the currency which is in their favor and subsequently being protected also. So if I give you an illustration of how the contracts work, this red one is the monthly futures. So you have 12 serial monthly contracts available, and then the blue ones are the monthly options. So we have 3 serial monthly options, and then every quarter we have a contract available for participants to hedge. And the new contracts are generally introduced immediately after the conclusion of the current month contract. There are specific strikes on which options operate. So not getting very deep into it, because if somebody has an understanding, they can definitely get into a question and answer session and they can clarify on it. On the currencies, FCY INR pairs, we are having a tick size or strike price interval of 25 paise, whereas in the Euro USD as GBP USD, we are having a 5 paise interval, and the USD JPY, it is 50 paise interval. Minimum strike of 12 in the money, 12 out of the money, and 1 near the money contract is available. And the table below is basically indication of how the strike prices generally are available. So if you look at this 80 rupees 50 paisa, the previous strike is 80 rupees 25 paisa and subsequently 80 rupees. Then the positive side or the higher side of the strike price, base strike price is 80, 75, and then 81, and so on. So this is how the strike prices are available, and whoever wants to participate in options, they generally have to select any of those strike price and then get into a position on the exchange. Now, looking at the market timings. Market timings have been already touched up by Siddesh, but here for you to understand on the future currency to Indian pairs, the market is open from 9 AM till 5 PM. So whatever time the interbanking market or the banking market is not available, people can use that for protecting that particular risk, or probably the overnight risk, whichever is arising after the OTC market is active. They can use the exchange platform. On the cross currency side, it trades till 7:30 in the evening. So that can also be utilized for people who are having exposure in the respective currencies. Now coming to the settlement process, settlement here we do a daily settlement because M2M mark to market is applicable and mark to market is done at end of the day every day. So whatever positive or movement in the currency has been there as per the position of the participant, that if it is a positive movement, the amount is credited to their ledger, and subsequently if it is negative, that amount is called for, that is called a marking to market. Then there is a final settlement on the closure of the contract, which is basically on the expiry day of the contract. So what is the expiry days? The expiry days in the exchange scenario is basically 2 working days prior to the last working day of the banking system. I'll repeat, whatever is the last working day of the banking system, 2 days prior to that, around 12:30 p.m., the current month contract ceases to exist. So after that, whatever prices are there, that would be converted into spot price, and then settlement would happen on the last day of the banking system. So that is the reference rate which is taken care and settlement happens there. Whereas on the exchange side, if somebody wants to roll it over, they'll have to do it before 12:30 p.m. on the last trading day of the current month contract, and subsequently do the transaction for roll it over to the next month. Mark to market, I've already covered. Basically, this is a sense of how the mark to market is happening. So if say somebody is taken a position at 81 rupees 91.50 paise, and if the settlement price, that is end of the day price is closing at 86.50, then there is a 5 paise negative movement, and this 50 rupees is basically called for as a negative movement in the currency for the positions taken by this particular participant, and subsequently it goes on till the contract is expiring. Now, understanding a real case scenario, probably making you understand how the currency markets work and how different participants can use it. Taking with an example of an exporter. Say if an exporter is there who is having an exposure of say 1 lakh USD. Here we are taking USD because that is most relevant and most people understand it more easily. So if somebody is an exporter and is having an exposure of $1 lakh, which is expected to receive after say end of the month, then how does he protect himself? What is the risk? First of all, we need to understand the risk for an exporter is when the Indian rupee is appreciating and the foreign currency is depreciating. So in this, the benchmark price for the contract when the transaction is being billed or invoiced is taken at rupees 80. Then what would be the scenario for a 1 month contract? This is what we can look at this example. So for $1 lakh, the number of lots which are to be hedged on the exchange is 1,000, because as I mentioned in the previous slides, we are having a contract of $1,000, which is 1 unit on the exchange. So in that sense, multiplied by 100, you will get $1 lakh. So 100 units of 100 lots of $1,000 equals to $1 lakh on the contract size. So as an exporter, the risk is that if Indian currency is up, he would be at risk. So when the quote currency is the exporter would be facing a loss. So he must sell the futures contract and buy. So in that sense, what is the margin that is payable for him? On the higher side, it's not the exact number, it's on the higher side we have mentioned. Say if it is around 3%, for $1 lakh, the total margin which the exporter needs to deposit as a security deposit to the exchange is 2,40,000 rupees, and then hold till expiry. So there can be two situations or two cases where in one case either the USD INR would appreciate or the USD INR would, or probably the INR would appreciate to 79 or USD would appreciate to 81. In these two scenarios, how the exporter would be benefiting is what we'll look at. But needs to understand that is hedging is purely locking of transactions. It doesn't give you any profit, and it is not done with an intention of making profit of the transaction. So if somebody is not hedging and keeping the exposure open, that means that they are trying to speculate in the market. Some people say that I don't want to get into an hedging activity because that is very speculative. But if somebody is not doing a hedging, that would also amount to hedging speculation, because he never knows what is the price that he'll be realizing or what price he'll be paying. So he's speculating in the market, and whatever situation be, he'll have to admit that profit or loss in his books. Whereas people who have done a hedging, what would be the scenario? This would be here. So somebody has sold dollars at 80 rupees. The conversion rate on the expiry of the contract, or probably the remittance whenever it is received on 27th October, indicatively where it is there in the example, it says if it is 81, then for $1 lakh, 1 lakh rupees is a negative scenario, negative return for the exporter on the exchange, because he sold it at 81 and is squaring out 80 and squaring it off at 81. So there is a negative 1 rupee movement for him, which would be recovered from the exporter by the exchange. Now, what happens in the real market when somebody is paying the funds to the counterparty, converting it, receiving funds and then converting it in the bank? So it is converted at 81 rupees because that day's spot price is 81 in the banking system. So 81 pay it is getting converted, and he has hedged it at 80. 81 minus 1 lakh rupees, which is made a loss on the exchange platform. Net to net, his realization is at 80 rupees only. So whether be it in the favor or not, his realizations are as per the invoiced transaction price or the benchmark price. Now take a reverse case where, say, the Indian rupee is appreciated and the reference rate on the conversion for the remitted dollars by his counterparty is converted at 79 rupees. Had he not hedged it, he would have received only 79 lakh rupees versus 80 lakh rupees as per the invoice. So as he has hedged on the exchange platform, we'll see what the situation would turn out like. So he sold at 80, bought it again at 79 because he'll have to square it off. The squaring off is done, that is a reverse position. If somebody sold it, they'll buy it back. So he's sold at 80, buying at 79, is making 1 rupee positive movement, and that is given by the exchange to the exporter on his ledger. On the bank's system, when he goes and asks his bank to convert those $1 lakh which is received from the customer, they would convert it at 79 rupees only, because again, that is the reference that they'll not do it at 80 rupees. So if the conversion is happening at 79, if it is not hedged, then he will definitely would have indulged in, incurred a loss of 1 lakh rupees. But as this 1 lakh rupees is again from the exchange side, his realization would again amount to rupees 80 lakh only. So that is how futures help exporters or be it importers to lock the transaction at the benchmark price, and they need not be worried about the cash flow management and margins management. This is how the payout would be for futures. Now, quickly running you through an example of an importer, which is completely reverse of this example of an exporter. Say is an importer, he is out to pay $1 lakh to the counterparty for, or the foreign company which is importing from. Again, the benchmark price being at 80, decided upon when the contract is finalized. He gives a similar amount of margin to the exchange, and on the closure of the contract, he'll get that margin back. See, in a scenario where the USD INR is appreciating and USD is appreciating to 81, he would be paying 1 rupee more to the invoiced price or the benchmark price or the contracted price if he is not hedged. So as an importer, where somebody is hedged, he'll get 1 lakh rupees from the exchange, and the conversion at the bank happens at 81. So net to net, his realization again on his books is the cost doesn't change over, doesn't impact their costing, neither their profit margins also. In case if it is a importer and then the INR is appreciating, importer is there. If Indian rupee is appreciating, it is beneficial for him. But in this scenario, he need not get benefited of the currency, but the locking the transaction and would be able to see to it that realization is the benchmark price only. Quickly running you through the options. I'll not take much of time over here. As I told you that the options are traded on strike prices. So in options, what happens is you pay an amount of premium, and the risk of the participant is to the extent of premium which is paid. Whereas on the futures, because the position is open, the margins are given, the payout is linear, which you have already seen in the charts. On the option side, the downside is limited and the upside is much better than the other scenario. Why? Because the risk involved is to the extent of only the premium which is paid to the exchange or paid to the counterparty. We'll quickly run you through an example over here. As an exporter, if somebody has done it, strike price of 80, again the same example of the previous slides which we have done. As an exporter, the downside is if the currency, Indian currency is appreciating. So what he does is, in futures, he has sold it. On options, he would buy a put option. So a put option is right to sell. So he's trying to exercise that right of selling by taking a position for a premium of 40 paise per dollar. So his risk in the currency would be to the extent of 40 paise only. So he's paying an amount of 40 paise per dollar for the entire $1 lakh as an exposure. He's paying 40,000 rupees as a premium. Now here premium is an expenses. It is not a security deposit vis-a-vis a futures contract. On the settlement day, what would happen? If the case unfolds where the reference rate or the currency is appreciating, the USD is appreciating and going to 81, then in the previous case, he was liable to pay 1 lakh rupees to the exchange because the difference is there. Whereas on the options, he would not exercise the option and would leave the premium which is given as unutilized, and he would take the position. So here the loss is only to the extent of 40,000 rupees or 40 paise per dollar, whereas 1 rupee is the movement in his favor, so he's cashing upon on that position. Whereas on the counter side, if it goes to 79, then his risk is completely protected and he would get that 1 rupee difference from the exchange, and the conversion would happen in the real time at 79 on the banking system at the reference rate available on the expiry day of the contract. This is how the payoff would be for options for an exporter in options. So the loss is limited to the extent of premium paid, and then whatever gain he is having, he is getting. That means that the downside is available for him to get a benefit in terms of USD. So if USD is depreciating, he would be benefited. If USD is appreciating, then only the premium is what he is losing. Similar for an option importer. So if importer is there, scenario would be again the premium is the risk. If the USD is appreciating, then he would definitely get benefited. And if INR is appreciating, the risk is involved only to the extent of premium which is paid, which is 40 paise a year. So this is how the real case scenarios generally work for participants to understand, and generally use these platforms for hedging the currency risk in the market. In terms of initial margins on the future side, there is an initial margin of 1.5% and an extreme loss margin of hypothetical around 50.5% available for USD INR pairs. And then subsequently for other pairs, the margins differ. For options, if it is somebody is taking counter position, that is writing an option, then span margin is applicable and accordingly margins are to be taken. If people are taking contracts for 2 different months, like say somebody is both having an import as well as an export, but the payment times or cycles are differing, so they can immediately for a single shot take a position through a spread contract. So for that spread contract, the margins would be for a 1 month contract, it would be 500 rupees, and then so on, which is already visible over here. In terms of collateral, what type of collaterals are accepted for giving margins? Cash Cash in the sense any amount of a NEFT or a check transfers to the bank account of the broker, subsequently broker remitting to the exchange when the decision is taken by the client, that is amounting to cash transfers. Or cash equivalents can also be available. Cash equivalents can be in the form of fixed deposit receipts, bank guarantees, liquid mutual fund units, or any of the GSEC, Government of India securities in the form of sovereign gold bonds, trade bills, or GSEC, that is government securities. Or even if apart from that, any more financial assets in the term of equity shares or mutual fund units, whichever are available according to the respective haircuts which are given by the exchange, they can be accepted, but in a 50-50 ratio. That is 50% should be cash, 50% should be non-cash. Now, understanding the participants over here on the exchange platform, all the players who are there in the OTC market plus the other liquidity providers in the form of hedgers, traders, and arbitrators. These are the participants on the exchange platform. And the category of participants we want to drill down more, it is basically banks, trading members, corporates, foreign portfolio investors, individuals, and yes, to some extent, with some caveats, NRIs are also allowed to participate in the exchange traded currency derivatives market. Benefits for looking at the exchange traded market is it is transparent, it is very low on the impact cost, which is already discussed by our colleague Siddesh in the previous presentation. It's in direct access, so there is no intermediary or any middleman allowed available. You can yourself look at the screen, and then if you are having an understanding, you can do your hedging activity accordingly. It's highly flexible platform. You can use it as per your requirement with a strategy, probably a strategy of mixing both futures and options you can do. So that flexibility is available on the exchange platform depending upon the exposure of the counterparty. Extended market timings, as we have mentioned, that the interbanking market runs till a specific time, and then probably you can use the extended market on the exchange, that is FCYNR or the cross currency pairs, to do hedging on the exchange and reduce your overnight risk. As well as you can do a structured deal if somebody is managing a treasury properly. This is how the exchange trading screen looks at, and this is what we were talking about, trading in 4 decimals. So though this slide is a screenshot is a bit old, but for you to give a glimpse of how generally it happens, 80 rupees 73.00 paise is what it is trading, and the lower side is on the selling side, it is 80 rupees 74.90 paise. So this is how generally it is available and available for the participants to look at and understand how the currency markets happen on the exchange. In terms of position limits for corporate, 6% of the higher of the 6% or total open interest, which is not exceeding $20 million available for USD INR, and then subsequently for other currency pairs also there is a specified amount available. For the domestic participant, they can take a long or short position without having any without establishing any proof. So even retail participant, that is how they do it. For corporates who are not having exposure more than $100 million, they are not required. And now the rules are getting tweaked. So in some cases, some ask is there if the positions are heavy, and then probably some justification is just called for, and clarification is asked from the participant. Take position in excess of the above limits, documentation or the underlying proof has to be provided. Gross position is computed as high as higher of the long position, which includes long futures, long call options, short put options. So option writing and going long on option is also a position a criterion for considering the value of the position over here. No underlying exposure required for any cross currency pairs, so participants can use this platform for reducing overnight risk as their currency if they are having exposure to different markets. This is the reason generally why people do hedging, because at the beginning of the month of the contract, both the futures and spot price are different. So there's a spread between both the two, and when the come to the expiry of the contract or probably the closure of the month, both converge at the same point. So that is why hedging is more important for market. A small indication of how the business has grown and how participants have handfully accepted this platform and are willfully using this platform for managing their currency risk. This is a growth in options which we're talking about. Few developments which have gone ahead in the platform is that we've introduced few weekly futures and options contract on FCY NR pairs also. FPIs and NRIs are permitted to participate on the exchange platform to the extent of their exposure in Indian currency. RBI also intervenes on the exchange platform when they want to do an open market operations through the banking system and so on. So this is all about the exchange traded currency market from the exchange perspective to understand how the regulations work. Exchange, what scenario importer or an exporter needs to doing currency risk management. And one thing which is most important is to understand while doing an international trade or probably getting into import and export is have a proper hedging tool or hedging policy so that you don't indulge into speculating into currency fluctuations and you take informed decisions for and be answerable to your own board or probably your own team when the financials are being prepared and basically asked by an auditor or so. So by this, before concluding, this slide basically shows what is the process of getting enrolled with a broker and how to start. So you need to select a broker, do a normal KYC, and this is a one-time KYC. It doesn't require to be done time and again. The moment you get a UCC code, whenever you wish to take a position, counter position on the exchange, you post your margins and then you are ready to trade. Whatever your platform is, either be it through a dealer of the stockbroker or through your own trading screen or a mobile-based trading platform, whatever is accessible to you and which is more useful to you, whichever you feel is convenient, you can use those and start doing it. With this, I'll conclude the presentation. I'll be very thankful to the chapter for giving us this opportunity to talk and share thoughts on the currency side. Thank you. Over to you, sir.
Sir, my sincere thanks to you on behalf of Hyderabad branch and all on behalf of all the members. Members, do you have any questions before we conclude formally? Anybody want to ask something? Thanks. Okay. We will share the PPTs in the branch website, sir. We will host. So if no other questions are there, sir, I request the branch staff to share the virtual mementos to the speakers. Sir, it is small token of gratitude from our side. We thank you so much for your valuable time and sharing an elaborative discussion.
Siddesh sir, it's your moment.
Please share Abhishek sir also. We will be sending these photographs and these mementos to virtual mementos to you, sir, through email also. Thank you, Siddesh Gare sir, and Abhishek Gaur sir. We wish your cooperation will be like this in future also. My sincere thanks to the branch chairman for arranging this wonderful deliberations. Sincere thanks to all the participants also who are